Dear learners of BBA and MBA programs and their viewers, how are you? Hope you are keeping well and ready with necessary papers and pen. If not, I request you to bring some blank pages and a pen now and keep them with you so that you can jot down the important parts of the program during broadcast. Learners, let us know what topics we will discuss today. Today, we will discuss the basics of adjusting entries, the types of adjusting entries and the passing of adjusting journal entries from your textbook Financial Accounting or Principles of Accounting. First of all, the basics of adjusting entries. Adjusting entries are journal entries which are made at the end of the accounting period to ensure that revenues are recognized in the period in which they are earned, expenses are recorded in the period in which they are incurred, so that the balance sheet and income statement accounts have correct balances. As per accrual basis, adjusting journal entries make it possible to report correct or up to date amounts on the balance sheet and on the income statement. The trial balance we prepare after journalizing and posting may not contain up to date or complete data. This is so because there are some events that are not recorded daily, even they can be recorded so. For example, the daily use of supplies or stationery like paper, pen, envelope, baskets, rubber, etc., or the earnings of wages by the employees. And there are some costs which are not recorded during the accounting period because they expire with the passage of time rather than as a daily use. Examples are rent, insurance, etc. And there are also some items that may not be recorded. An example is a utility like gas, electricity or water bill that the company will not receive until the next accounting period. Adjusting journal entries must be made when the financial statements are prepared. Thus, if the financial statements are prepared monthly, adjusting entries are required to made monthly, though by custom the financial reports are made annually. Learners, now we will discuss the types of adjusting entries. Adjusting entries can be classified as either prepayments or accruals. Prepayments consist of prepaid expenses and unearned revenue. Accruals on the other hand comprise of accrued revenues and accrued expenses. Learners, let us discuss these adjusting entries one by one with examples. First of all, adjusting entries for prepayments. Adjusting entries for prepayments are made to report the portion of the prepayment that represents the expense incurred or the revenues earned during the accounting period. I mentioned earlier, prepayments can be of prepaid expenses or unearned revenue. First of all, prepaid expenses. Prepaid expenses are expenses which are paid in advance and recorded as assets. Why are they called prepaid? Because the benefits of this prepayment will accrue for more than the current accounting period. The examples of most common prepaid expenses are advertising, supplies, rent, etc., or the purchase of fixed assets like buildings, equipment, furniture, machinery, etc., are also a sort of advance payment. Prepaid expenses are costs that expire either with the passage of time like interest and rent or through use or consumptions such as supplies. The expiration of this cost does not require daily transactions. Companies postpone recognizing this cost until they prepare financial statements. At each statement date, organizations make adjusting entries to record the expired cost or expenses that apply to the current accounting period and to record the unexpired cost in the asset account. And the journal entry for the prepaid expense is expense account debit and asset account credit. For this adjustment, the expense or income statement account is increased and the asset or balance sheet account is decreased. If the adjustment for this prepayment is not made, the assets will be overstated and the expense will be understated. Learners, let us look in more details at some specific types of prepaid expense, beginning with supplies. Businesses use various types of supplies. For example, a CA firm may use office supplies like stationeries, envelopes and accounting paper. An advertising firm may use advertising supplies like graph paper, video film, poster paper, etc. Companies normally debit the supplies in the asset account when they acquire them. In the course of operations, supplies are used, but companies postpone recognize their use until the adjustment process. At the end of the accounting period, companies physically count the remaining supplies, and the difference between the supplies shown in the trial balance and the supplies on hand represents the supplies used or expense for the period. Suppose on October 5, Nahid advertising agency purchased advertising supplies at a cost of taka 25,000, and Nahid recorded these transactions by debiting the asset supplies by taka 25,000, and the October 31st trial balance also shows this amount of taka 25,000. An inventory count at the end of the accounting period, that is October 31st, shows that only 10,000 of supplies are still on hand. So, the remaining balance of taka 15,000, that is taka 25,000 minus the 10,000 is expired or used. So, the advertising expense will be taka 15,000. For this sense, Nahid makes adjusting entries as you see in the screen. Advertising supplies expense debit taka 15,000 and advertising supplies credit taka 15,000. This is due to the expiration of or use of the assets supplies, and here the expense or income statement account is increased and debited, and the asset advertising supplies is decreased and credited. If the adjusting entry for this prepayment is not made, then the expense will be understated and the net income will be overstated in the income statement by taka 15,000, and both the assets and owner's equity will be overstated by taka 15,000 in the October 31st balance sheet. Let us discuss the adjustment for prepaid with another example of insurance. Companies pay insurance premium in advance for the losses due to fire, theft or unforeseen events. For this prepayment or advance payment, the prepaid insurance is normally debited, and at the end of the accounting period it is credited for the amount expired, and then the insurance expense is debited. Suppose on October 4, Nahid advertising agency paid taka 6,000 for a 1-year insurance policy. The policy coverage began on October 1. Nahid recorded this payment by debiting the prepaid insurance, and the October 31st trial balance also shows this amount of taka 6,000. But during the period of October, the insurance of taka 500, that is 6,000 divided by 12 for 1 month, has been expired. So, Nahid makes adjusting entry for this sense as you see in the screen. Insurance expense debit taka 500 and prepaid insurance credit taka 500. Here, due to the expiration of the prepaid insurance, the expense, I mean the insurance expense is increased and debited, and the asset prepaid insurance is decreased and credited. If Nahid does not make this adjusting entry, the expense will be understated and the net income will be overstated by taka 500 in the income statement. Also, both the assets and owner's equity will be overstated by taka 500 in the October 31st balance sheet. Learners, let us discuss with another example of depreciation. Companies typically own buildings, equipment, vehicles, etc., and record them as long lived or non current assets during the period in which they acquired them. According to matching principles, companies then report a portion of the cost of these assets as expense during each period of its useful life, which is called depreciation. Depreciation is the process of allocation of an asset's cost over its useful life in a rational and systematic manner. Suppose Nahid Advertising Agency purchased the office equipment at a cost of Taka 50,000 on October 2, and its useful life is expected to be 10 years and salvage value is Taka 2,000. So, according to straight line method, the depreciation for the year will be cost Taka 50,000 minus the salvage value Taka 2,000 divided by the estimated useful life of 10 years, that is Taka 4,800. So, the depreciation for the month of October will be Taka 4,800 divided by 12, that is 400, and Nahid makes for this sense the adjusting entry as you see in the screen. Depreciation expense debit Taka 400 and accumulated depreciation credit Taka 400, and at the end of the accounting period the accumulated depreciation will increase by Taka 400. That is, after journalizing and posting on October 30 it will be Taka 400, and on November 30 it will be Taka 400 plus 400, that is 800, and on December 31st it will be Taka 1,200. Learners, now we will discuss another type of prepayments, that is unearned revenues. Unearned revenues are those revenues which are not earned. You know, as per revenue recognition principles, revenues are earned when the goods or services have been sold. Here, in the case of unearned revenues, the cash is received in advance and recorded as liability as the goods or services have not been sold, that is, the revenues are not earned. Unearned revenues may occur in regard to rent, magazine subscriptions, customer deposits, etc. for future services. For example, US Bangla Airlines receives cash in advance from its passengers for the sale of tickets, and it treats these receipts as unearned revenue until it provides the flight services. Suppose on October 2, Nahid Advertising Agency received Taka 12,000 from its customer Shine Enterprise for the advertising supplies it will provide later, and the October 31st trial balance also shows this amount of Taka 12,000. But the analysis reveals that during October, out of 12,000 only 4,000 of services have been earned, and Nahid makes adjusting entries for this Taka 4,000 as you see in the screen. Unearned service revenue debit Taka 4,000 and service revenue Taka 4,000. Here, due to providing of services, the liability, that is unearned service revenue, is decreased and debited, and the revenue, that is service revenue, is increased and credited. Learners, what will happen if these adjustments are not made? Without this adjustment, the revenues and the income statement will be understated by Taka 4,000 in the income statement, and the liabilities will be overstated and owner's equity will be understated by Taka 4,000 in the balance sheet. Learners, now we will discuss another category of adjusting entries, that is accruals or post payments. And I mentioned earlier, post payments or accruals can be of accrued revenues and accrued expenses. At first, accrued revenues. Accrued revenues are those revenues which have been earned but not yet recorded at the statement date. Accrued revenues may result from the passing of time, as in the case of interest or rent revenue, or they may result from the services performed during the accounting period. At first, it records the receivables that exist at the balance sheet date, and it records the revenues that earned in the current accounting period. Let us discuss with a practical example. Suppose Nahid Advertising Agencies earned Taka 2,000, but this amount has not been recorded in the books of account. So, if Nahid records and makes adjusting entry, the journal entry will be as you see in the screen, accounts receivable Taka 2,000 and the service revenue credit taka 2000, and on November 10, if NIDE receives a cash of taka 2000, the general journal would be cash debit taka 2000 and accounts receivable is credit taka 2000. Learners, now we will discuss another type of accruals, that is accrued expenses. Accrued expenses are those expenses which have been incurred, but not yet recorded in the statement date, and the examples are rent, insurance, advertising, etc. And at each statement date, the adjusting entry for accrued expense is made to record the obligations or liabilities that exist at the balance sheet date and the expense which is incurred in the accounting period. Suppose NIDE advertising agency signed a taka 50,000 notes payable on 3 months, which bears a 12% interest rate. So, NIDE makes the adjusting entry for this transaction interest expense debit and interest payable credit taka 500, and this is calculated as taka 50,000 multiplied by a 12% divided by 12, that is for the interest due on October. Learners, we are at the end of our today's program. I think you have understood our today's presentation. If you have any query or problem regarding our today's presentation, you can consult your textbook and the concerned tutors. No more today. See you the next class. Till then, Allah Hafiz.